Welcome to the Investor Edge. Meta Platforms just dropped its fourth quarter results, and on the surface, it looks like a blowout. But here is the shocker. While they are telling everyone 2025 was the year of efficiency, their infrastructure spending just jumped 73% year over year.
That is a massive discrepancy, Mark. They are preaching lean operations while planning to spend up to $135 billion on capital expenditures in 2026. To put that in perspective, they are becoming a capital-heavy infrastructure giant almost overnight.
Exactly. Today, we are going to dive into why the market is giving them an 8% rally despite these eye-watering costs. We will look at the pivot from virtual reality to personal superintelligence and whether their core ad engine can actually outrun this spending spree.
Listeners will learn how AI has industrialized their ad business, the truth behind their Reality Labs losses, and the specific price levels traders are watching right now.
Let's talk numbers. Revenue for the quarter hit $59.89 billion. That is a 24% surge from last year, beating analyst estimates by over $1 billion.
And for the jargon check, revenue is simply the total money coming in before expenses. Earnings per share, or EPS, which is the portion of profit allocated to each outstanding share, came in at $8.88. That beat the $8.19 estimate by over 8%.
The Family of Apps segment, which includes Facebook and Instagram, is still the king. It accounts for over 98% of total revenue. Advertising revenue specifically grew 24.3%.
But look at the margins, Mark. Operating margin, the profit a company makes after paying for variable costs of production, dropped from 48.3% to 41.3%. Why? Because total costs and expenses spiked 40% year over year.
They are also carrying more weight on the balance sheet. Long-term debt doubled to $58.74 billion.
They also have a weird GAAP versus adjusted net income situation. GAAP stands for Generally Accepted Accounting Principles. In the third quarter, they had a one-time $16 billion tax charge from the One Big Beautiful Bill Act. This quarter, things normalized, but we have to look at normalized cash net income to see the real picture.
Management is now guiding for up to 30% growth in the first quarter of 2026. That would be their fastest growth since 2021. Here is where it gets interesting. There is a serious say-do gap at Meta right now. The biggest red flag we found is the year of efficiency narrative versus the actual ledger.
Right. Management says they have a disciplined efficiency mindset. But the data shows costs and expenses rose 40% this quarter. They aren't just trimming fat anymore. They are building a private cloud that rivals Google and Microsoft.
Discrepancy number 2, the Reality Labs peak. Mark Zuckerberg previously claimed losses here would peak and then level off. Sarah, what do the numbers say?
The data shows Reality Labs' operating loss was $6 billion this quarter. That is actually up from $4.4 billion in the third quarter. So the peak looks more like a mountain range that is still climbing.
The third discrepancy is about their business model. They claim to be an efficient software company, but with a $135 billion capital expenditure guide, they are acting like a utility or a hardware manufacturer.
Zuckerberg even admitted in the Q&A that their roadmap for return on invested capital, or ROIC, might be unfulfilling for now. ROIC measures how well a company uses its money to generate profits. He basically told investors to trust the feedback loop of ad growth while they spend hundreds of billions on superintelligence.
It is a build it and they will come strategy. They are replacing human labor with massive, high depreciation machine costs. If you are a short-term trader, here is the educational framework. The stock is currently around $716. We are seeing a critical floor, or support level, between $671 and $674.
That is where the 50-day and 200-day moving averages cluster. A moving average is just the average stock price over a specific period to smooth out the trend. The RSI, or Relative Strength Index, which measures the speed of price changes, is at 62.7. That is neutral to bullish, meaning it has momentum but isn't overbought yet.
For an entry zone, Some traders look at that $670 range with a profit target of $760 to $775.
Now let's look long-term. If you believe the bull case, the math looks like this. Meta's AI agents create a new revenue stream on WhatsApp and Messenger, pushing total revenue above $300 billion by 2028.
In that scenario, if we assume a 3-year projected EPS of $45 and a price-to-earnings multiple of 25, the target price is $1,125. That is a 57% return over 3 years.
But if you believe the bear case, the math is grimmer. If the $135 billion spending spree crushes margins and the digital ad market saturates, EPS could stagnate around $23.50.
If the market then derates the stock to a commodity tech multiple of 15 times earnings, the price target drops to $352. That is a 50% downside.
4 different investor types. Growth investors might see a strong buy because Meta is actually the most undervalued mega cap on a PEG basis. That's price to earnings to growth. Value investors might wait for a CapEx panic pullback below $600. Income investors should note the tiny 0.28% dividend yield. This isn't an income play.
The key takeaway today is that Meta has transitioned from a capital-light social media app into a capital-heavy AI infrastructure titan. Whether that gamble pays off depends entirely on if personal superintelligence can monetize faster than the machines depreciate.
It's a fascinating watch for growth investors, but the sheer scale of the spending makes it a show-me story for the more conservative crowd.
That wraps up today's deep dive on ticker META. If you found this analysis helpful, please like the video, subscribe to the Investor Edge, leave us a 5-star review, share this episode with a fellow investor, and follow us on Spotify, YouTube, and X. If you want us to cover a specific stock, please email us at opalfinancial1@gmail.com. We read every message. We appreciate your support, and that means a lot for us.
As always, this episode is for educational purposes only. This is not financial advice or a recommendation to buy, sell, or hold any security. We're not registered investment advisors. We don't know your personal financial situation. All investments carry risk, including loss of principal. Do your own due diligence and consult a licensed financial advisor before making any investment decisions. This is The Investor Edge, produced by Opal Financial LLC. Please reach out to opalfinancial1@gmail.com for any questions you may have. Thanks for watching.